All right. Mic check. Okay, we're good. All right, welcome to another webinar. Today we're going to be talking about the fundamentals of Forex trading, but this is going to be a second version from the previous one we did. Okay. All right. If you're new here, welcome. What we normally do in these webinars is we teach you about Forex and give you quality information on how you can be a profitable trader. In the course of this training, if you have any questions along the line, you can write them down in the comment section and I'll be constantly checking to answer them. Okay, but before we go into this webinar today, you can drop your name and your location from where you're joining us from. So type in the comment box your name and your country, your state, wherever you're joining us from today. Type in the comment box and I would welcome you. Okay, we have Riaz from Pakistan. Welcome, Riaz. Welcome. While we type our names in the comment section, I'll quickly go to or resume from where we stopped in the last webinar. We have Foluso Akinwumi, that's a Nigerian name. Welcome. We have Wo Sifamandla from South Africa. We have Shilpa from India. We have Isaac from Lagos. Okay, welcome you guys. So we're just quickly going to talk about how to create a demo account, right? Which was where we stopped in the last webinar. How can you create a demo account? The first thing you want to do is you want to go to OctaFX.com. And when you go to OctaFX.com, you click on either Trade with Us, or you're going to see a different button at the top right. Whichever button you click is going to pop out this form where you can fill your name, or you can fast track. You can use the fast link to where you can sign up with your Facebook account or your Gmail or Apple account, right? So we're just going to use the fast link and sign up. Now you're going to a different page is going to pop up where you can put your email and your first name. I think your email is already going to be set in. Your first name, your last name. You're just going to fill in these basic details, but make sure that your details are correct. And then you have to choose from where you want to trade, what platform, MT4 or MT5. So selecting MT4, make sure that your account type is set to demo and you're trading in USD. In the course of this training, I would explain what leverage is to you guys so that you can know which leverage you prefer to use. And your starting balance is going to be $5,000. I would not advise you to go above $5,000, but for the purpose of this webinar, I'll be using $1,000 as my starting balance. And once you click continue, you're going to be moved to a different page where you can see your dashboard. Now this is a demo account, it's not real cash, right? But at this point, an email will be sent to you. Remember the mail you used to sign up, right? So you can go ahead and check your inbox for that welcome email that is going to contain your trading server and your login details and password. Okay, so what you want to do is, after getting your server and your login details, your login and your password, you want to download the trading platform. So you go to the home page, OctaFX homepage, you come here to trading platform and you click on desktop. If you're using desktop, if you want to get the Android app, you can click on Android or iOS. Okay, so for me, I'm using desktop, so I'm just going to go ahead and click on desktop. and then it's automatically going to pop up which folder I want to save the setup file. Now I have already gone through this process. I've downloaded the trading app. So the process is it's really easy. You download the setup file and then you click on it, and every step is very easy. So I'm just going to skip this because I have already downloaded the trading app, right? So I'll just put that up. So it's going to be saved in your PC as Octa Market, right? So remember, you were set if you check your email, you were sent a login and a password. Now those are the details you would use to log into your trading terminal. You're going to use it to log into your demo account. It's really important that you take note of the server. I've already logged in here, so make sure that the server, like as you can see, there are different servers, so make sure that the server is the same as the server that was sent to your email, right? So once you put the details correctly and you click login, you should be here. Like I said, I'm using $1,000 as for the purpose of this webinar today, so you should be here, right? We'll come back to this. Before I go ahead to today's content, I would like to also welcome two of you guys. You have Hussein from Pakistan, you have Charles from Nigeria, you have Moyo from Nigeria, and then you have Raghu from India. Okay, welcome. Now, the first thing we're going to talk about today is terminologies used in Forex, right? It's important that when you're trying to trade the market, or if you're around a group of traders or analysts and they're using some terms, you wouldn't want to get left out, right? You wouldn't want to get confused. So these are the terminologies, and these are their meanings. Now, to go long means to buy, to go short means to sell. So if I make a statement or I make a sentence and I'm like, I'm going long on GBP USD, it means I want to buy GBP USD, right? If I say I'm going short on GBP USD, it means I want to sell GBP USD, right? That's simple. You have a bullish market and you have a bearish market. A bullish market is a market that is moving in an upward direction, and a bearish market is a market that is moving in a downward direction. Let me quickly show you guys an example of what I mean by that. Okay, so what you see right here is a GBP. This is a GBP USD chart, and as you can see, the market is moving this way, right? It's moving in a downward direction, so you can easily call this a bearish market, right? Now, a bullish market is the exact opposite, right? USD JPY, where is it heading? Upwards. So you can easily call this a bullish market. That's simple. Next one is bulls and bears. So the bulls are called the buyers and the bears are called the sellers. A lot of you might be wondering why are we using bulls and why are we using bears? Now, in real life, if a bull wants to attack you, it attacks from, with the horn downward, attacks you upwards, right? Fling you away down. So that's why it's called the bulls. The bulls attack from here, from down to the upside. And you know how a bear attacks? A bear attacks, from up to down. That's the same thing for the bears. That's why the bears are called the sellers. They attack from put this quick. Okay, so they attack from, how the bear attacks in real life, attacks from upward downward. So the bulls are called the buyers and the bears are called the sellers. Now, a ranging market is a market that is either moving upwards or downwards. Now the market doesn't have any specific direction. Let me see if I can get an example for you guys. A ranging market. Okay. So if you look here, you would see that this market doesn't have a specific direction at this point, right? It doesn't have a specific direction. It's moving. Look at this. It's just ranging. It's going up, it's coming down, it's going up, it's coming down. It's not, you wouldn't call this a strong bullish market or a bearish market. It's just ranging, right? It doesn't have a specific direction, moving from here to here, here to here, here to here, here to here, to here, to here. Okay, so you can call this a ranging market. If a market moves like this without any specific direction, you can call it a ranging market. Now, a trending market is a market that is moving in a specific direction. So just like I showed you guys here, this is a bullish market, right? You can also say the USD JPY market is trending upwards, right? You can also say the USD JPY market is trending upwards. If it's going down, you can also say, for example, the GBP USD is trending downwards. As long as it has a specific direction, it could be to the upside, it could be to the downside, but as long as it has a specific direction, then you can say the market is trending. Okay, I think this is really easy to understand, but if you have questions, remember you can drop them in the chat or the comment section and I would answer your questions. Okay, so some of these currencies that we use in the market have nicknames, like the USD is called the greenback, and GBP is called the cable, the NZD is called Kiwi, the AUD, which is the Australian dollars, is called the Aussie, and CAD, which is the Canadian dollars, is called Loonie, and all is also known as black gold. Now, in the first webinar that we did, Fundamentals of Forex Part 1, Forex Trading Part 1, we covered a lot of basic things that you should know, which includes currency pairs, how transactions are done in the market. So if you haven't seen or watched that webinar, you can go back after this webinar to watch that one so that you can have a pretty clear understanding of what we're doing. Okay, now the central bankers release news, right? And when they release this news, they tend to be hawkish sometimes and they tend to be dovish sometimes. Now, when the central bank is hawkish, in layman terms, they're trying to stop the economy from growing too fast. So the central banks is like, oh, the country's economy is growing too fast. Let's slow this down. What do? They increase the interest rate. When the interest rate is increased, you see a lot of investors, investing in that currency. So when the central bank is hawkish, it's actually positive to the domestic currency, right? But dovish, on the other hand, is the exact opposite. So the economy is moving slowly. They're trying to boost the economy and stimulate the economy. What do? They reduce the interest rates, right? Those investors take out their money. Why do these investors put their money in or invest their money in a currency, right? Remember, when central bankers are hawkish, they are increasing the interest rate. So most investors would want to profit from that interest rate. So they tend to invest more in that particular currency, right? So dovish is the exact opposite. But we're going to look at the monetary policies of hawkish and dovish. Like I said, when the central bank is hawkish, they are increasing the interest rate to stem inflation pressures. Now, forward guidance or reports from the central banks would include positive statements about the economic growth and inflation outlook. Dovish is going to be the exact opposite, right? So they increase the interest rate to stimulate the economy. And reports of forward guidance from the central banks would include negative statements about the economy. As a trader, it doesn't really matter if the central bank is hawkish or dovish, you can still take advantage of whatever action the central bank decides to take with regards to how their economy is going. You can still take advantage of their decisions and profit, right? Okay. If you have questions concerning the terminologies used in Forex, drop your questions in the comment section and I'll constantly check to answer your questions. So we're talking about lot size. Okay, lot size is the amount or quantity of a trade that you buy or sell. It's sometimes called your position size or your trade size. Now, from this point, we're going to be doing some calculations. Now, these calculations can only be difficult if you are distracted, so stay with me. Okay, now there are three types of lot sizes. You have the standard lot, you have the mini lot, and you have the micro lot size. The standard lot contains 100,000 units. It is represented on MT4 by 1.0, and the value per pip of a standard lot is $10. I'll explain what that means. The mini lot contains 10,000 units. It is represented on MT4 by 0.10, and the value per pip of a mini lot is $1. The micro lot contains 1,000 units, represented on MT4 by 0.01, and the value per pip is 10 cents. So let's go to, or let me explain to you guys what I mean by value per pip, right? So we're looking at GBP USD. GBP USD is currently valued at 1.3323, right? So let's put that down. 1.23. Now remember, if GBP USD was to move 1 pip to the upside, remember how to calculate a typical pair. We start from the 4th digit after the decimal point, right? For those of you that were in the last webinar, remember? So what is going to be the current value if GBP USD moves 1 pip to the upside? Simple. 0, you do plus 0.1, and this is going to be the value if GBP USD moves 1 pip to the upside. Now this 1 pip, if I am in this position on a standard lot, I would be profiting $10. If I am in this position, if I'm in this trade and GBP USD moves 1 pip to the upside and I'm using a mini lot, I'll profit $1. Now, if I am still on this position with a micro lot, I'll be profiting 10 cents. So they're just different trade size or position sizes. Let me explain further with these three traders. Now we have trader A, trader B, and trader C. Now these three traders are looking to make a profit, a daily profit of, they're looking to make a profit of 20 pips out of a trade. It could be daily, it could be just one trade, but they're looking to make 20 pips out of a single trade, right? Now trader A decides to use a standard lot size. I told you if you get distracted, you would miss out on the calculation. It's an easy calculation, so make sure you're not distracted, right? Stay with me. Good. This trader decides to use one standard lot. Remember, the profit target for these three traders is 20 pips, right? Trader A decides to use a standard lot size. A standard lot size is valued at $10 per pip. So it's simple. How do you get your profit from using a particular lot size? It's simple. So it's going for 20 pips, right? So value per pip multiplied by gives you your reward. Value per pip multiplied by pip profit gives you your reward. What do I mean by pip profit? Remember, they're going for 20 pips, right? So the value per pip for the standard guy is $10, right? Standard lot size, value per pip is $10. We're going for 20 pips. What's the formula? Value per pip multiplied by the amount of pips you want to make in profit. $10 value per pip multiplied by 20 pips he wants to make in profit. He's going to be profiting $200 from that trade, right? So value per pip multiplied by pip count in profit, whatever profit you want to make, is going to give you your reward in dollars. So this is how we got this guy, or this guy got $200. Now this second guy decides to use a mini lot size, the same 20 pips, right? This second guy decides to use a mini lot size, the same 20 pips. Remember the formula: value per pip multiplied by pip profit gives you reward, or value per pip multiplied by amount of pip will give you your reward. Now the value per pip for a mini lot is $1, right? Value per pip for a mini lot is $1, which means every pip move is going to cost you $1. Every pip move is valued at $1, right? So value per pip is $1 multiplied by, he wants to make 20 pips in profit, right? 20 pips. Result is $20. That is going to be his reward on that trade. Now the third trader, trader C, decides to use a micro lot size, the same 20 pips gain, right? Micro lot size, value per pip for a micro lot size is 10 cents. Value per pip for a micro lot size is 10 cents. Now going back, remember the formula: value per pip, which is 10 cents multiplied by 20 pips, which is the profit level. She's getting $2 out of the trade. Right now, it's really important to watch what lot size you're using to trade. In the course of this training, I'll also show you guys how to manage your risk. But let's say this guy decides, this trader B decides to go hard on his trade and uses a standard lot size for his account. Remember the formula: value per pip multiplied by pip profit. But now he has decided to go high, so the value per pip for him using a standard lot size would be $10 multiplied by 200, but by 20 pips rather. So $10 multiplied by 20 pips would give him $200 in profit. Big money, right? Imagine if this trade goes against this dude. He's going to lose $200, which is going to leave him with $800 in his trading account. So it is important for you to check your lot size, know how much you're risking per trade, know the correct lot size to use, which I'm going to teach you guys as we go on. If you've got questions concerning lot size, you can go ahead and ask me. I'm looking at the comment section to see if you have questions. But yeah, we're moving on. Leverage. What is leverage? Leverage is having the ability to control a large amount of money using none or very little of your own money and borrowing the rest. This is where and also the reason why most traders make money and most traders lose money if you don't understand the power of leverage, or if you misuse the power of leverage. In this illustration, you're seeing a trader with $100 starting balance or trading capital is able to be on the same balance with is able to control a $10,000 account because of the power of 1 to 100 leverage. I would explain to you guys the types of leverage and how you can use them to your favor. So we have 1-to-1 leverage, we have 1-to-10, 1-to-20, 1-to-50, we have 1-to-100 and 1-to-500. What this means, or 1:500, what this means is this one signifies your starting balance, right? And it's going to be multiplied by whatever you have on this other side to know the amount of leverage or buying power you have. So let's start with this. Now, 1-to-1 leverage, right? Same example, starting balance $1,000. If I have a 1-to-1 leverage, it means I can only use, let's do the calculation real quick. 1,000, which is my starting balance, multiplied by 1. I only have 1,000 units, right? Now, the value per pip, remember, 1,000 units value per pip is 10 cents, right? 1,000 units value per pip is going to be 10 cents. So this could be good for me, but it could also be bad for me, because now if I divide 1,000 by my value per pip, it's going to give me 10,000 pips. What does this mean? This means I have to lose 10,000 amount of pips before I can lose all my $1,000. It also means I have to profit 10,000 pips before I can double my trading balance. Now, let's say I'm a trader that makes 20 pips per day, right? 20 pips per day. So 10,000 pips, right? Divided by 20 pips per day. It's going to take me 500 days to double up my trading account, which is really, for me, I would say it's a huge, or it's too much, it's a huge amount of time for me to double up my trading account. Now, if we're going to divide this by 30 days, we're going to be having 16 months, right? Now, without leverage, it's going to take this trader with a starting balance of $1,000 16 months to double up his trading account, right? Now, with the power of leverage, it's also going to take him 10,000 pips in profit to double up his trading account. Now, with the power of leverage, let's say I'm using a 1-to-10 leverage, right? So remember, 1 is your starting balance multiplied by 10. So starting balance multiplied by 10. Now I have 10,000 in buying power. Remember, 10,000 is what? A mini lot. Now the value per pip is going to be $1. Remember, how do you know the amount of pips is going to take you to either double your trading account or lose your trading account? You do the buying power versus the buying power minus the value per pip. Buying power is 10,000 divided by rather. If you have any questions so far concerning these calculations, you can ask me. I'll redo the calculations so that you don't get confused. If I'm a bit too fast, you can also let me know. Okay, so back to the calculation. Starting balance for the 1-to-1 leverage, starting balance was divided by value per pip to get the amount of pips it will require, or you will be required to make in order to double your trading account, right? Now, for the 1-to-10 leverage, you still need your starting balance. The formula is starting balance divided by value per pip, right? So same starting balance, $1,000 divided by 1, which is the value per pip for the 1 to 10 leverage. Now you're going to need to profit 1,000 pips in order to double your trading account, right? You also need 1,000 pips loss in order to lose all your money. Now this is where traders make a lot of mistakes. So you're given the power to use high leverages like 1 to 100, 1 to 500. He has 500,000 in buying power. So he's like, okay, I have 500,000 in buying power, which means I can double my trading account per 20 pips, right? With all the calculations for this and this. It's the same thing for the 1 to 100 and 1 to 500. So a trader new to the market or that decides just to be greedy can misuse the buying power and say, okay, I have 500,000 out of buying power, right? And it means that it's going to take me 20 pips to double my trading account. Now he goes into the trade goes against him, he loses all his trading capital. Now, how do you take advantage of leverage so that you don't put your trading capital at stake for a certain amount of peak profit? How do you make leverage to work in your favor? The first way to do that is by using stop losses. Checking if you guys have questions so far. Okay. All right. First way to do that is by using stop losses, and I can't tell you about stop loss without also telling you about take profit. Now, take profit is an order used by traders to automatically close their position once a certain profit has been made, even when they're offline. Although it halts any further advance in profit, it guarantees a specific profit after a level has been hit. What does this mean? Let's take USDJPY as a case study, valued at 110.50. Remember how to calculate JPY pairs? You start from the second digit after the decimal point, right? Good. So let's say I'm hopping on a buy on USDJPY, and I want to take profit at 20 pips. Simple. I start from the second digit after the decimal point, add my 20, it's going to give me this. Now, setting a take profit to your trade it's just like you telling your broker, oh, okay, I'm going to watch a Champions League match, or I may not be online to be looking at my trades. I'm going out on a date, something. I need you to close this trade for me at this point in profit. Now, even if you're offline, even if your phones are dead, with no battery in them, no battery life, your broker is going to automatically close this position for you in profit. Most times, markets could exceed this position, and put you deep in profit, but the broker is going to close you right where you have given the order. Close me here, right? So that's for take profit. Stop loss is the same order, but you're telling your broker that, oh, okay, I've hopped on the buy, but if market wants to go against me, I don't want to lose more than 30 pips. So you're telling your broker that you have subtracted 30 pips from your entry point. Remember, to subtract from JPY pairs, you're calculating from the second digit after the decimal point, right? I'm not getting a lot of questions today, so I'll just assume that this is very, very explanatory. But yeah, you're telling your broker that, okay, I need you to stop me out at minus 30 pips. I don't want to lose more than 30 pips. You do your calculation, you put the value, minus 30 pips is going to give you 110.20. Now, for those of you that don't know what this small number is up here, it's called a pipette. You don't calculate that. You don't calculate the pipette. This small number that looks like a raised to power. You don't calculate that. So yeah, you put your stop loss level, and what's going to happen is, if this trade goes against you, to avoid further loss, your broker is going to close the trade here automatically so that you don't exceed a 30 pip loss. This is one way you can use to make take advantage of leverage and make it work for you in your favor. Joel John says, what is the advantage of SL in TP? Do you mean SL and TP or SL in TP? Okay, well, the advantage of SL is stop loss, right? So SL in TP is, general advantage of stop loss is so that your trade, you don't get to lose more than you want to lose, right? So let's say, let me give you an example now. Let's say so let's say this guy with a starting balance of $1,000 hops on this trade, right? Starting balance 1,000. The lot size is, for example, he uses a 0.10 lot size. That is a mini lot. Remember, a mini lot is valued at $1 per pip. So he hops on that trade. He's expected to come out with $20 in profit, right? Okay. $20 in profit for 20 pips. Now, if the trade goes against him and he doesn't use a stop loss, and this trade goes against him by 100 pips, that same $1 per pip is going to be multiplied by 100. So how much is he losing without a stop loss? He is losing $100. So he's losing $100, right? Now, if he had used a stop loss, 30 pip stop loss, instead of $100, remember the same thing, the same calculation, $1 per pip for a mini lot. Now, if he had used let me change this to black. If he had used a stop loss of 30 pips, right? $1 per pip multiplied by 30 pips. Now he would have lost only $30 instead of losing $100. So you see, this is why you can, or you should, use a stop loss. Okay. Checking to see if you guys have any other questions, or we can go ahead and look at the second way that you can make leverage work for you. Ragu says, why buying and selling values are different? You have the ask, but if you missed our previous webinar, you can, after this webinar, you can go back and watch that so you can understand. It's just the ask price and the bid price. The sellers have a price they want to sell to you, and the buyers have a certain price that you can buy from. Okay, the difference between the ask and the bid price, or the buy and the sell price, is the spread. It's just like your bank. You can't tell me that if you go to your bank to exchange your cash, let's say you're exchanging US dollars for Japanese yen, the bank is going to buy from you at a different rate, and they'll sell to you at a different rate. Okay, so that's just how it works. USJPY, can I sell it? This is not this is just for education purposes. I'm not asking you to sell or buy any currency pair. Okay, we're looking at the second way you can make leverage work in your favor. Second way is by using a risk reward ratio, right? So still using the same example, the same starting balance $1,000, and for example, if you're using a 1 to 2 risk reward ratio, what does this mean? I'm risking 1% of my trading account to profit 2% as reward, right? So how do you get 1% of your trading account? Simple. Normal way to get percentage. 1000 divided by 100 multiplied by 1%. Let me quickly do that so you can. So 1000 divided by 100 times 1, $10, right? So your 1% risk on a $1000 account is going to be $10. Your reward is the same thing, 1000 divided by 100 multiplied by 2 to get your 20%, your 2% reward on this starting balance, right? Now, it is important that before you hop on a trade, it's important that you know how much you're risking on that trade. You don't want to just open trades unnecessarily or open trades without a profit target or without knowing how much you're risking for that trade. That is why most traders still lose money. So you need to know how much you're risking on a trade and how much you're going to be profiting on that trade, but most importantly, how much you're risking, right? So now we've agreed that we are risking 1% to profit 2% on a 1000 on this starting balance, right? So let's just call this my account, and I've agreed to risk 1% to profit 2%. I've gotten my 1% value in dollars, which is $10. I've gotten my reward value, which is $20, right? Now remember, you've gotten the risk and reward, you've known how to put your stop loss level. What lot size should you use? What lot size should you use? Now, there are three types of lot size: the standard, the mini, and the micro. Now, you cannot use the standard because standard is valued at $10 per pip. So if you hop on a trade, on this trade, or if I hop on this trade right now, and it moves 1 pip against my my favor, or against my trade, against my position, if I'm on the buy, and it moves 1 pip to the downside against me, then I would lose my 1% risk. I don't want that, right? Now, which other lot size can I use? The mini? Okay, let's check the mini. The mini is valued at $1 per pip. That means if my trade moves $10 against my 10 pips against my favor, I'll be losing my 1% risk. With the way markets are moving right now, market can just decide to move 10 pips against my favor, right? So I don't also want that. Now, how exactly am I going to find the right lot size to use? Remember, personally, I use 20 to 30 pip stop loss. You can decide how many pip stop loss you want to use, but to help you calculate, you're going to take $10, which is your 1% risk. Let's say I want to risk 50 pips on stop loss. I divide it by 50 pips. That's giving me 0.2. What does this mean? 20 cents. What lot size goes with 20 cents per pip? The micro lot size, 0.02. I'll explain it to you guys again. Now, remember, 0.01. Change this to black. Yep, 0.01 as a lot size is valued at 0.10 cents. So valued at 10 cents per pip, right? Which means if I have divided the amount I'm willing to risk by the amount of pips I'm also willing to give room for the market, if it decides to go against me, then I'm getting 20 cents per pip, which means my lot size is going to be 0.02. Right? Now, remember, if you decide to use a large stop loss like 100 pips and you divide your $10 by 100 pips, then you're going to be using the 0.01 lot size. Keep in mind that whatever you're risking is still going to be the same calculation for your reward. Now, if I'm risking 1% to get 1% reward, that means I'd have to make this same 100 pips if I'm going to get 1% reward. For the explanation right here, remember you're getting 2% reward. So if I'm risking 100 pips for $10, right? I'm like, okay, I want to risk $10, but I'm giving a gap of 100 pips. To get my reward, I'd have to make 100 pips multiplied by 200 pips. So that's like huge. Okay, so for the example I gave you guys on 50 pips stop loss, where I said you'd have to use a 0.02 lot size, I would also be looking to make 100 pips in profit before I can make 2% of the reward in the risk to reward ratio. Georgian says, what happens when you don't set your SL and the trade goes negative and later moves to your advantage? Sometimes you lose more with stop loss. Why? It's all about discipline. You know, if most times you can trade without stop losses, and then the trade moves back into your direction. But I can assure you that you won't completely do that for the rest of the year and be successful for the rest of the year. One very good day, the market is going to knock you out so bad that you would regret why you did not use a stop loss. Using a stop loss is disciplining yourself on risk to reward. You don't want to be a trader without a plan. If you don't use a risk to reward ratio, then you're trading without a plan. If you're trading without a plan, what are you trading? So yeah, I've experienced what you're saying, Joel. Sometimes I could use stop loss, and then the market hits my stop loss and goes back to where I expected the market to go. But that is trading for you. You don't give the market enough room to start putting you in loss because you're hoping that it's going to go back. If you do it a lot of times and it works for you, one time or one day, you're going to pray so bad for the market to go back, and it's going to keep you in constant loss till you lose all your money. So the reason why you should use stop loss is so that you can discipline yourself, know how much you're risking, know how much you're making from the trade. It doesn't matter how many times you win or you lose. What matters is how much do you make when you win, and how much do you lose on the losing trade. Okay, I hope I've answered your questions correctly. Yeah, so where did I stop? Okay, so 50 pips, right? So I'm looking to make 100 pips in profit before I can make 2% of my trading account. Now 100 pips is a little bit too much, right? So let's come down a little. Let's say this guy wants to use, or I want to use, because I'm using myself as the example with the starting balance, right? So I want to use 20 pip stops divided by 20. This is 50 cents, right? What lot size does this fall under? Still the micro lot size. Still the micro lot size. Keep in mind that a micro lot size is from 0.01 to 0.09. The mini lot size is from 0.10 to 99, and the standard lot size is from 1 upwards, right? So where does 50 cents fall under? 50 cents fall under falls under the micro lot size for 0.05, right? So if 20 cents is 0.02, then 50 cents is 0.05. So what does this mean? I'm risking 20 pips for $10, right, divided by 20 pips. So let me take this all out. I'm risking 20 pips with a 0.05 lot size, and my risk amount still remains the same, $10. Now, to get my reward, remember 1:2 formula, right? Risk to reward, 1:2. So if 20 pips is 1, how do I get my profit? Multiply by 2, 40 pips. So 0.0, made a mistake, 0.05, which is the required lot size I want to use for this particular trade. If I'm risking 20 pips, 0.05, to get my profit level, I just have to multiply by 40 pips. If you don't know how I got 40, before I click equal to, if you don't know how I got 40, remember 20 pips is the risk and my reward is 2%. So I just multiply 1, which is the risk, 20, by 2. That's why I got 40 pips. Now, how much is 40 pips going to give me? Exact same multiplication. Oh, mistake. Okay, so the calculation is 0.50, which is 50 cents, not 0.05. You're multiplying your value per pip by the amount of pips you want to make in profit. Okay, so you're not doing the lot size. You're not doing this. Okay, so you're multiplying the value per pip by 40 pips, and now you get 20 pips. So you're risking 1% of your trading balance, which is $1, which is $10, to get 2% of your trading balance, which is $20. Risking 20 pips to get 40 pips. I think it's not too far compared to when we did 200 pips or 100 pips. It's easy to come out of the market with 40 pips profit, right? It's much easier compared to 100 pips and 200 pips. So that's how you calculate your risk to reward ratio. The same thing for risk to reward for 1 and 3. Oh, doing the higher the pips. Gosh, come on, I'm trying to read your question, but I don't really understand it. Does this mean the higher the pips, the higher money you risk? It doesn't entirely mean the higher the pips, the higher money you risk. Remember, the first thing I told you to do is to set your risk amount. Your risk amount is now going to determine how you're going to spread the pips, right? So do not exceed, from this illustration, I did not exceed the $10 risk, but I was able to minimize the amount of pips, right? So it doesn't really matter if your pips is 100 pips or 50 pips, as long as you've stuck to this amount as your risk, and then you have divided to get your lot size. You can use the same $10 for 100 pips, but your lot size is going to be 0.01, not 0.05 for your 100 pips. Now that's a huge amount of pips, like the question you were asking. Okay, so it doesn't really it's not the amount of pips that determine, as long as you have set the amount that you want to lose, use the required lot size, and then if you get stopped, fine, you don't exceed the amount that you risk. Okay, and the next thing, which is the last thing we're looking at, is types of pending orders. Types of pending orders. We have limit orders and we have stop orders, right? Now, a limit order is an order placed either buy below the market or sell above the market at a certain price. Now, I'll explain what I mean by buy below the market. Put up my chart in a bit. Okay. All right. There we go. Okay, now the GBP USD, obviously bearish market. Remember, the buy limit says either buy below. Now, for a buy limit, you're placing your order below the current market price, right? So let's say I want to hop into the market right here, but I'm like, if I hop into this market right here, it could go down a few more pips. So instead of hopping into the market here, I place a pending order. The pending order doesn't execute until market price has gotten to that point. So I place the buy limit below in anticipation for the market to get down here, activate my trade and move up. So the buy limit is placed below in anticipation that the market is going to get down and then start moving up. For the sell limit, remember the same definition, sell above. So it's just the opposite, right? Buy limit you're placing below, expecting the market to come down, and then activate at your position or at your price, your entry price, where you place the pending order, and to start going up. Now, like I said, the order doesn't start, your money wouldn't start reading until market gets to that point. Sell limit. So for sell limit, you're placing your order above the current market price. Where is the current market price? Right here. This red line you're seeing is the current market price. Now you're placing your order above the current market price in anticipation that once market gets to that point, it activates your entry and market starts to come down. Buy limit you place below, expecting the market to activate below and start pushing up. Sell limit you place above, expecting the market to go up, activate and start dropping. The second type of pending order we have is stop orders. Stop orders. Now, a stop entry order is an order placed to buy above the market or sell below the market at a certain price. Now, you're placing for sell limit, for sell stop rather, sell stop, we're talking about stop orders right now. You're placing your pending order, your sell stop order below the market price, expecting market to get down here and continue going down. So you're placing for a sell stop below the market price. You're expecting market to do what? Get down here and continue going down. Sell limit you're placing above for market to go up and drop. For sell stop, you're placing below for market to get to your entry point, where you placed your pending order, and continue going down. For buy stop, excuse me. Okay, so for buy stop, you're placing your pending order above the current market price, expecting market to get to your entry point where you have placed the pending order and continue going up. That is for buy stop. Buy limit you're placing below, expecting market to get to your entry point and go up. Buy stop, you're placing above the current market price, expecting market to execute the trade right there and continue the buy trend or wherever, or continue to the up direction, to the upside. Okay, so do you make profits when market hits your buy limit and goes back up? Wisdom is asking, do you make profits when the market hits your buy limit and goes back up. Yes, remember it's a buy, right? It's a buy limit. So you're placing the buy limit order here, expecting market to come down here and start shooting up. So if market doesn't get to this point, your trade would not be active. But once market gets to that your entry point where you placed your buy limit, it's going to be active. And if market starts to push upwards, you're going to be in profit. Because why? You placed a buy order, right? So if you place the buy limit order and market is moving up, you're in profit because market is, buying. Same for sell stop. Sell stop, you place below. If market activates and continues going down, you're in profit because you placed a sell pending order, right? Sell limit, same thing. If you place above the current market price, market gets there, activates your sell, market starts to drop, you're in profit. Okay, so I think that's self-explanatory. This is where we are going to wrap up this webinar. If you've got questions, I would use the next 2 minutes to answer your questions. We had a previous webinar. We have a previous webinar where I talked about the fundamentals of Forex trading. Basic things that you should know about Forex, which include the definition, how transactions are carried out in the market, currency pairs, and how to calculate pips. A lot of vital information in the first webinar. So if you missed that and this webinar is a little bit confusing for you, you can go back and watch the previous webinar before you watch this. Also, if this video is or was helpful for you, you can click the subscribe button so you can get more helpful videos as time goes on. Okay. Ragu says for one lot 1.0 equals to 1 pip, $1. No. For one standard lot, 1 pip is valued at $10, not $1. The lot size that is valued. Okay. Yeah. For $1, the lot size is mini lot size. A pip move for a mini lot size is valued at $1. So that is not for the standard lot size Ragu. Okay, we've come to the end of today's webinar. I really appreciate you guys for hopping on today. I'll see you guys next week. If you have questions that I haven't seen or I can't answer right now, you can go ahead and type them. I'll answer them in the next webinar. Okay, one last question. Baba Lola says, how can we download this video? You can. The video is going to be here for you to watch and rewatch till you understand everything. So thank you guys for coming.